I'm lying to you.
Okay.
I'm
so-
fully lying to you.
No, it's okay. No problem. No problem.
This is going to make it to the bloopers, isn't it? I can see that.
Icebreakers,
Okay.
icebreakers.
Icebreakers. Okay, back at it.
Bloopers really good.
Sometimes it's good to treat yourself. Yeah, no, mine is every day. Like if I'm just having a bad
Yeah.
I just gotta treat myself.
Holiday
It's
one time.
so bad.
Welcome back, guys, to another show of Soko Simple, where we take a deep dive into the world of finance, investment, and everything in between. Join us today as we are going to encounter one of the most important topics that we normally underrate it from time to time, and we are going to talk about the fixed income investment. And I know I've heard you guys kept on saying that there are too many males in this sector, there are too many male faces. So today, I brought for you a gorgeous lady with a brilliant mind, Miss Nicole Lagat.
Okay, wow.
Yeah, introduce yourself.
Hi everyone, my name is Nicole Lagat. I am a fixed income operations associate at Standard Investment Bank. And I hope I can help you guys learn a little bit about investing in fixed income.
Don't worry, this is Soko Simple. We basically put the fun in investments.
Okay, sorry.
So let's start with something simple.
Yeah.
How's your day been? And it's only 9 a.m.
Yeah, it's only 9 a.m. But it's so far so good. There was no traffic, so that's good.
So that's the highlight of today.
Yes.
No traffic.
No traffic. I saw a glimpse of the sun. It's gone now, but it's fine.
It will come back, don't worry.
Yeah.
It's summertime.
Yeah.
So now
Is it?
It's summer every day in Nairobi.
Okay.
And now today we're going to start with something about how did you venture into the capital markets?
Okay, so I studied financial economics at Strathmore. And
Clearly, Strathmore alumni is always rapping.
Always rapping. Yeah, small but mighty. Yeah. So when, I don't know, in third year we did a unit on the financial markets, and I think from then I was just like, I just want to get into the financial markets.
Yeah.
Although, funny enough, I was not interested in fixed income. My boss is gonna see this. I was not interested in fixed income, but I actually came to really, really enjoy it. Like being here, I'm having a blast. I love what I do.
Okay.
Yeah.
And where are you currently?
Standard Investment Bank.
Okay. So was it the first employment you got straight out of uni?
Yes, actually. Yeah, actually, I got it before graduation, like a few weeks before graduation.
Oh, okay.
Yeah.
Yeah, and you're thriving right now.
Yeah, we're doing our
Always.
best.
So now, Nicole, I have a string of questions which I want to ask you today.
Okay.
And we're going to start with the most simple one. Please explain to us what fixed income investments are.
Fixed income is basically a debt instrument whereby you, as an investor, loan out your money to a corporate or the government, and they give you back interest periodically until maturity, where you get your principal amount.
Okay.
Yeah.
So is it normally compounded?
No.
Okay.
No. So it's set date. So for example, in Kenya, we have our if you're doing like bonds, treasury bills, treasury bonds, what happens with the bonds is the government gives you, they'll tell you, we're giving you an infrastructure bond or a fixed coupon bond for this many years, let's say 6 years, and in May you're receiving this amount of money, because it's it's a percentage. So maybe it's a 17-year bond. So in May you're going to receive about 8.5%, and then so it's 6 months, 6 months. So in November you're receiving another 8.5% return.
Okay.
So that's what usually happens. It's fixed
Income.
Yeah.
Investments.
Fixed income investments.
So now, an example would be, you mentioned about the T-bills.
Yes.
That's Treasury Bills, right?
Treasury bills and then treasury bonds. So actually, those are two different fixed income products. So for treasury bonds is what I've mentioned. They pay you periodically. So in Kenya, it's 6 months, 6 months from when they're issued. For treasury bills, however, we call them discounted products. So what that means is you'll give the government, so the minimum is 100,000 to invest. You give the government 100,000, they'll give you a rate after, you know, they've discussed, they've met, they'll give you a rate, then they'll tell you on the day they've discussed and all the results are out that you need to pay maybe, let's say 97,000, and then if it's a 91-day T-bill, you'll pay the 97. After those 91 days, you're given back 100,000. Yeah.
Easy money, guys.
Easy money.
Easy money, because how fast is it for you to spend? Okay, now let me ask you, how fast is it for you to spend 100K? Like you have 100K right now to spend. How fast will you spend it?
Oh my gosh. So I used to think it was a lot of money a long time ago, but nowadays it's so quick to end. I have you have rent, you pay a couple of bills, and then you're left with a little for yourself.
For enjoyment.
For enjoyment. A little bit.
A little bit.
Yeah. And so you know you have to save. You have to save as well. Don't forget to save.
Yes, save, guys.
Yeah. And invest.
So now, the next question which I want to ask you is, why might young investors consider adding bonds or other fixed income securities to their portfolios?
So basically, the easiest answer would be diversification. So you'd always want to diversify your portfolio because, for example, if you have shares and treasury bonds, if you're looking right now the current trends or just how the trend has been, maybe for the last 1 year, you'd see shares were going down. And the interest rates, on the coupon rates on bonds is high at the moment. Like we have an infrastructure bond at around 18.4%. So if you look at that, if you only had shares, you would feel like you're in a bad position. But you see, if you've hedged it with bonds, then you don't feel the pinch as much. So there's that,
So now there's this, on a bonds price list, there's this column which has the yields, which is in percentage.
Yes.
So could you explain to us what a yield is, what it means?
Okay, so yield is basically the price that you pay for the bond. So it's what determines the price of the bond. So in a normal, like just a Soko, normal market, you go in and maybe, like the floods that we had, I remember somebody in my colleague lost all the beans that they had planted, So which means beans generally at that time were not doing well because they were flooded. So when you go to a market, beans, the price is higher. So yield is kind of what determines the price for everyone at that time, so because of such, for bonds now it would be economic matters. So like maybe finance bill, a very sore subject, but finance bill, for example, I'm not saying it had any effect, but for example, if it did have an effect in the negative, you would see the yields going up. And then if there was good news or something, you'd see the yield going down, which means if the yields go down, your price for the bond goes up and vice versa. Yields are what determines the price in the market. So when you come to us as brokers, we'll tell you, we'll give you a yield based on what's in the market. So NSE, you guys, you provide us with that basis so that maybe we don't overcharge the client or undercharge the other client, So when yield is high, and it's based on economic factors. So when the yield is high and higher than the coupon, which is basically your interest, you would pay more. You'd pay more for the bond, But in the event that you have, like right now, you have the 8.5 year at 18%, but it's trading at 17. So the coupon is higher than the interest. You'd actually pay, you'd pay more, and then the vice versa. So if the interest rate is higher than the coupon, you pay less, so you pay a discount. So the 17-year that we had in the primary, there was a tap sale, and there was also the previous primary. If it has a coupon of 14%, but the rates right now, as I said, are at around 17. So that would mean you'd pay a discount.
Okay.
So usually the yield will help you know, like, if you're going to pay more, if you're going to pay less, based on the type of bond that you're interested in, if it's a fixed coupon, if it's an infrastructure bond. Most of the time people prefer to pay less. But at the same time you have to look at the coupon of the bond. So for example, if you're looking to get way more, you'd have to be willing to pay slightly higher. So the 8.5 year is now my basis for that, you know.
That's currently that's the most latest bond The most current IFB.
IFB, yeah, it's the most current IFB, the best one. So you guys should go buy it. Minimum is 100,000 to invest.
100K.
So, and you'll get your 18K.
Yeah,
18K. No, you'd get 9K half yearly, but then you'd get 18K in a year. I mean, that's money you didn't have.
Imagine,
and
guys, this is passive income. You're making money in your sleep.
Yeah, and you don't have to think about it.
Yeah.
Yeah, so that's something.
Yeah, that's something. Small change for enjoyment.
For enjoyment.
I don't know, guys. You're saving.
We're trying to save. We're trying to save.
Right. So, how do factors like interest? Oh, you've already talked about it, but
Yeah.
let me just ask: how do factors like interest rates and inflation impact fixed income investments?
Okay, so with inflation, I know not many people know know what it is, but they just know it's bad.
Yeah.
I'm not going to go into what it is, but it's bad. So when inflation is high in the economy, most of the time you'll see like you're more rigid in terms of spending, like your enjoyment imeshuka, and because things become more expensive, like cost of living is a bit higher and all that. Now imagine you are trying to borrow money from me and there's high inflation. I am more rigid in terms, and you're trying to borrow from me, yeah? So I am more rigid to give you that money because I'm thinking, with the way things are going,
This economy,
things are thick. I don't know if I really want to do that. So your incentive would be to raise how much you're gonna pay back. So you'd give me a higher, like the interest would be higher. I'd charge you a higher interest basically, yeah. Which means, so if I was to, if we're talking coupon payments, yeah, if inflation is high, most of the time you'll see like the government would, give you an incentive. So they'll also raise the coupon payment. So that's how we ended up like with the 18%. At the time we were dealing with repaying our Eurobond. Yeah, it was a tough time. Inflation was high, so we have high interest rate, which means you have a high incentive to lend your money. So basically that's what usually happens with inflation. Now on the downside, however, we do have existing bonds in the market. We have infrastructure bonds that are at about 10%, 10.6%, and you see you've put in that money for those years. So if it's like 12 years, I've told you you're getting your 10%. At that time, that was a good rate. Yeah. Right now, there's 18%, and you don't have that. They're not gonna correct that 10% to match the inflation right now. So there's that factor that you need to look at. So anyone who's holding that 10% bond is more likely to feel like I need I'm feeling bad. I need to get into the new one. But now, as I said, if interest rates are high. If your yield, because you see yield would also move up, so if yield moves up, that 10% is going to be a big loss now because the coupon is at 10. So you need to look at something like that. So that's how inflation affects bonds and interest rates basically in our markets.
Okay. Yeah. So now, Nicole, Soko Simple is proudly sponsored by the NSOO Soko Play, which is a virtual trading platform. Yes. It allows investors or upcoming investors to learn, practice, and then now trade, but with simulated cash. So you have virtual cash. Once you just register, you're given virtual money. Well, why am I telling you this? And have you registered?
I have not. I'm not gonna lie.
Would you register? What are you waiting for?
Clearly, I was waiting for you to call me. Now here we are.
So yes, you see, currently, what's at the virtual trading platform is, it's only at the first stage is we're only dealing with stocks. Okay. But would you advise or would you find it more incentive for now when we put another fixed income investment into the platform?
Yes, 100%. As I said, diversification is so important, especially in your portfolio. You need to diversify your portfolio just to hedge any risk that the time brings, economy brings, life happens. So I think it's important for people to also get the opportunity to learn what will happen when they have all of the products in their portfolio, or maybe even 2 or 3. There's derivatives as well. Yes. So they can see how to to play around with all of the investment options they have. Also to just understand maybe it might also help them understand their risk appetite. Maybe you're risk averse and I'm, I don't mind taking up the risk. So, I'd do a bit more, like you would opt to maybe put more in fixed income because they're termed or they're said to be a bit more risk-free than shares. Don't take me to be that serious. Governments have defaulted, companies have gone down, but they're said to be a bit at least risk-free in comparison. So you would at least opt to have a portfolio that's largely based on fixed income. Me, I'm interested in seeing what's out there because I'm more I'm more a risk taker, so I would maybe do shares and try different things, move up and down here and there. So I think it's important for all of those options to be available. And then also just for people to understand, like I might have told you, when the yield is higher than the coupon, you're making a loss, or if your coupon is higher than those such things. You don't understand what I'm saying, but if you saw it for yourself, or you got to experience it for yourself, it would be easier to understand. If you come to me as a broker, you know what you expect, based on the yields you've seen on NSE, based on how the market has been moving, because I assume you'd also peg it to the market, to how the market is going, so people have real-time understanding of what's going on. I think it would be really important for them to get that experience. Also for something like to understand a discounted bond, like what I just said, the 17-year versus paying a premium in the secondary market or even in the primary based on a reopening. So such things.
So all that information will be displayed over there.
You should, yes, hopefully. And also just to understand tax, because some bonds are taxed and some are not. So you'd also see the return you're making.
In version 2 will put it there.
Version 2, not version 1. Okay, it's fine. It's okay.
It's okay.
Yeah.
So ladies and gents, there you have it. You've heard it from the one, the only Miss Nicole Lagat. Thank you for coming here. We usually have a bell over here, but hey guys, we actually need to bring that bell back. But
was I supposed to ring it?
Yeah, imagine that.
Did everyone else ring? That's so unfair. I'm the first girl and you guys don't give me a bell.
Guys, it's his fault.
It's okay.
Thank you, Nicole, for coming.
Thanks for having me.
We've come to an end of the show.
Yeah.
Let's
Unfortunately.
keep the Soko simple.
Okay, for sure.
Yes, too many more. And guys, there's an upcoming investment challenge which is coming up September 9th. Sign up, register to the platform, and stand a chance to win cash prizes.